Yeah, good evening, everyone. So I am CA Alok Garg, and today we are going to discuss Ind AS 20, accounting for government grants and disclosure of government assistance. This standard is relevant for those companies who are getting grants or some assistance from the government in their business operations. So we are going to cover this particular session in next 35 to 40 minutes. So coming to the agenda of the discussion. So first of all, we'll discuss what is the objective of this standard and what is the scope of this particular standard. Then we are going to discuss what is meant by government grants. Then we'll discuss how this government grant is going to be recognized and what is the accounting treatment in case the company receives the government grants. Then we will discuss something about non-monetary grants. When the government is not paying cash to the company, rather government is providing a land or government is providing a machinery to the company, then how this non-monetary grants is going to be treated. Then we will talk about presentation of government grant in the balance sheet and P&L of the company. Then what happens in case the grant which is given by the government to a particular company is required to be repaid by the company to the government in the subsequent years. In that case, what will be the accounting treatment? Then we will talk about what is meant by government assistance. And then we will discuss what are the key differences between accounting standard and Ind AS. And we'll quickly cover the disclosure aspect of Ind AS 20. So these are the 7-8 agenda of this particular standard. Coming to the objective part. What is the objective of this standard? As the name suggests, accounting for government grants and disclosure of government assistance. So this standard talks about, when I say accounting for government grants, so this standard talks about the entire accounting which includes disclosure of government grants. And when I said government assistance, so just to clarify, although I'll discuss this in detail, but just to clarify, government grants are those grants which is having some monetary value, where the value is placed on it. Okay. And when I say government assistance, so government assistance is something where the value cannot be derived, and hence the qualitative disclosure can be made, but the quantitative disclosure cannot be made, or and when there will not be any value, in that case the accounting cannot be done. For example, if the government has given a land to the company, in that case the land is having a value and hence it is a government grant for which the accounting can be done, for which the disclosure can be done. But if the government has provided some moral support, if the government has provided some support in purchasing and selling of goods, for example, if a company is operating in a rural areas, so government has developed a road which is connecting to the factory of the company to the main city or to the urban areas. Okay. Second, the government has started some public transport from the factory of the company to the urban areas or to the city, so that the employee workers can reach out to the factory. Or government has developed a portal where the government has provided a free access to the company for identifying the buyer, identifying the seller, okay, for selling their goods. So government is supporting the company in its business operation. So this support cannot be quantified in value, and hence it is nomenclated as a government assistance. And that is why this standard talks about accounting treatment for government grants and disclosure relating to government grants. So when I say government grant, everything is there. But when I say government assistance, only disclosure is there. Accounting is not there, because accounting cannot happen because there is no value placed to it. So now you have understood that yes, there are two sections. One is government grant and the second one is government assistance. Okay. Coming to the scope part, on which area this standard is applicable. So this standard is applicable to government grants and other form of government assistance, except so wherever any support from government is there, wherever government is transferring any resources either at a subsidized rate or at a free of cost, then this standard will be applicable to, except some situation. What are the some situation? If the government is providing some tax holidays, for example, You must have heard about the section 80IA, 80IB, where if the company is installing its plant or factory in a rural area, probably government will provide in a tax holiday period. So when I say tax holiday period, means for the next 10 years, the company is not required to pay any income tax. So if the company is getting some tax holidays, a particular set of companies which are installing in a particular area or operating in a particular area, they are getting some income tax benefits, income tax holidays. In that case, this standard does not come into play. Although Ind AS 12 income taxes, that standard will be applicable in such situation. Okay. Biological asset. If the government grant is related to any biological asset, then Ind AS 20 is not applicable. Ind AS 41 is applicable. Okay. So in this situation, it is not applicable. In this situation, it is not applicable. Government participation. When I say government participation, means if government is infusing any equity in the company, government is a owner, government is a promoter in any company, and the government is infusing any capital, in that case, it will not be considered as a government grant. For example, in Delhi Metro Rail Corporation, so the equity is funded by government of Delhi and President of India. When I say President of India, central government. So central government through President of India and government of Delhi, Delhi government through Lieutenant Governor. Okay. So in this case, this will not be considered as a government grant. Accounting of government grant reflecting the effect of for changing prices. For example, government has regulated the prices of some commodity, okay, or government has taken some steps to curb the inflation or to put a ceiling on the prices. So if these kind of things are there, it will not be included in this particular standard. Correct? Let's move on. Now let's discuss what is the definition of government and government grants. Sir, if a grant is given by Mr. Alok Garg to a company, whether it will be covered under government grant, answer is no. So let's discuss who is government and what is meant by grant. Coming to the meaning of the government, government refers to the central government. When I say central government, Prime Minister of India, okay. When I say central government minister, President of India, central government. So the government which is sitting as at central level, okay, ministries, central government, state government. When I say state government, government of Uttar Pradesh, government of Delhi, government of Karnataka, state government, government agencies and similar bodies like Municipal Corporation of Delhi, NDMC, North Delhi Municipal Corporation. Okay. So central government, state government, government agencies and similar bodies, whether local, national or international. For example, World Health Organization. If it is an international government body, so it will be considered as a government for the purpose of this particular standard. Okay, whether local, national or international. UNICEF. Okay, so it is an international government bodies. It can be treated as an international government bodies. Okay, if it is a similar bodies, similar to the government. Okay, government grants. And what is meant by grant? So of course, if the grant is given by such parties, central government, state government, government agencies and similar bodies, whether local, national or international. So government grants are assistance by the government. It is a support by the government. But when I say support, there must be a value placed to it, value attached to it. Government grants are assistance by government in the form of transfer of resources, to an entity in return for past or future compliances with certain conditions relating to the operating activities of the entity. First of all, what is meant by government grant? Government grant is an assistance, support by the government in the form of transfer of some resources. There must be some transfer of resources. For example, government is transferring or government is providing a land free of cost, machinery free of cost, land or machinery at subsidized rate. Government is reimbursing the cost of the plant. The government is reimbursing the price. If a company is purchasing a goods at an X price, so the government is reimbursing the price which is more than X. Okay. So of course, transfer of resources are there. And why government is transferring the resources to another entity? In return for past or future compliances. So government has told, if you want to, or if you will install your plant, if you will inaugurate your plant in the rural areas in Chhattisgarh, of course, I will provide you land free of cost. So if the entity is doing that, the entity has already started incurring its operation in rural area. The government has provided the land to that entity. So in return for a past compliance or in return for a future compliance, government is saying, so if you will install your plant here, so there will be a lot of generation of employment, there will be a lot of support to ancillary industries, and there will be development of this area. Okay, so we are providing land now, and our objective is to just ensure that you will inaugurate or install your plant here and you will generate X level of employment. Okay, so government is transferring the resources to the entity in return for future compliances with certain conditions relating to the operating activities of the entity. Government grants exclude those government assistance which cannot have a value. So in this case, this standard talks about government assistance which does not have a value, and for those government assistance, disclosure is required. Accounting cannot be done, okay, and cannot distinguish from normal trading transactions. Again, coming to the government grant, what are the types of government grant? What could be the example of government grant? Grants received from government against reimbursement of expenses. Okay, so first the entity is incurring some expenses, then the entity is submitting a document for getting the reimbursement of those expenses. Okay, so this is again a government grant. Or against expenses, government is providing some money to the hospitals that please treat the COVID patient free of cost. So it is government is providing in advance, and now they have to treat the COVID patient, they have to incur the expenditure. So this is against expenses. Or fulfillment of certain conditions, or when you will fulfill some condition, or when you have already fulfilled some condition, then we are providing you some government grant. For example, you are ready to inaugurate, you are ready to install or start your operations in rural area, so we are providing you a land. Okay, you have not incurred any expenses, you have started your operations, and that is why we are providing you land free of cost or at a subsidized rate, because you are fulfilling some certain conditions which is given by us. Okay, in all these cases we need to apply Ind AS 20, which is nothing accounting for government grant and disclosure of government assistance. What could be the examples? Subsidy given by the government for procurement of material. So government is saying you have to incur an expense of ₹100 on procurement of material, and we will reimburse 20%. Okay, or we will provide you this raw material at a subsidized rate. Free allotment of land to the government, free allotment of land given by the government. Forgivable loan is government grant when entity meets certain condition of forgiveness of loan. Forgivable loan means the government is providing a loan to the entity, and government is saying if you will meet some conditions, okay, in that case we will waive off this loan. For example, government has given 5 lakh rupees of loan to the entity. The repayment period is after 5 years, and government has said to the company that if you will generate an employment to the extent of 5,000 employees, we will waive off this loan. Okay, so when the condition of forgiveness will be met, then this forgivable loan will be treated as a government grant. Interest-free loan or loan at a concessional rate. For example, government has given interest-free loan. In that case, the grant which is related to the market rate of interest will be considered as a government grant. Or the market rate of interest is 10%. The government is under subvention scheme. The government is providing a relief to the company, and government is providing a loan at 4%. So this 6% will be treated as a government grant. Recognition, sir. When the grant received from the government will be recognized. Is it recognized when the money has actually been received, or it can be recognized even though the money has not been received? So the answer is government grant should not be recognized. So it is a reverse definition. Government grant should not be recognized until there is a reasonable assurance. I can say that. So I don't know why the standard has given a negative definition. I can say that government grant should be recognized when there is a reasonable assurance. Okay, so government grant shall be recognized when there is a reasonable assurance. For what reasonable assurance? Reasonable assurance that entity will comply with the conditions and grant will be received. For example, So government has given a grant worth rupees 10 lakh to the company. Okay. And this and the government has given a condition that you have to generate an employment to the extent of 5,000 people in the next 5 years. Okay. So the money has actually been received. Now the amount has been received, but as an auditor, as an accountant, you need to see whether the entity will be able to comply with the condition. For example, the promoter don't want to start its operation for the next 3 years. So it will be very difficult that in 2 years, the company will be able to engage 5,000 employees. There is no HR department. The company don't want to start its operation for the next 3-4 years. So in this case, grant, although money has been received, but government grant will not be recognized because this condition is lacking. Okay. So you need to see two conditions. One, entity will comply with the condition and grant will be received or grant has been received, already has been received. In that case, the government grant is required to be recognized. Okay. So what is the accounting? So we understood when there is a reasonable assurance that the entity will comply with the condition and the grant has been received or will be received. In that case, we will recognize the government grant, but what could be the accounting? So the government grant is recognized in P&L for the period in which expenses for that grant had already been recognized on a systematic manner. So first of all, if the government grant is related to an asset, for example, a company has purchased a machinery and the government has given a grant related to the cost of the machinery. So this grant has to be amortized in the P&L over a period when the depreciation on the machinery is recognized in the profit and loss account. So income on government grant has to be recognized in P&L in the same manner or for the period in which the related expenses has to be recognized in the profit and loss account. So this recognition of government grant, this accounting of government grant has to be on a systematic manner going by the matching concept. Sir, what happens if the government has given a grant to a company and for that the condition has already been complied in the past? In that case, the entire grant has to be recognized in the P&L upfront in the current year in which the grant has been received. Okay. So it is clear this government grant has to be recognized in the profit and loss account over the period in which the expenses relating to that grant has been recognized in the P&L in a systematic manner. The related contingent liability or contingent asset is treated in accordance with Ind AS 37. Okay. So for example, the company has recognized government grant because the entity is certain that yes, we will be able to comply with the condition. And this condition has to be fulfilled for a period of 5 years. Okay. So until and unless the 5 year will not be completed, the related amount has to be shown as a contingent liability, because due to unforeseen circumstances, if the company will not be able to comply with the conditions, then in future, the company has to repay the government grant. Okay. So that is why the contingent liability or contingent asset is required to be recognized, not recognized, disclosed in the notes to accounts. Now coming to the accounting or presentation for grants, which is either related to assets or related to income. So there are two kinds of grant. One, if the government is giving a grant which is related to the assets. Second, the government is giving a grant for the purpose of routine expenses or for the purpose of expenses. Okay. For example, if a company is if the company is constructing a hospital, in that case, if the government is providing a grant for the construction of hospital, it is considered as a grant related to assets. Second example, the government is paying 50% of the OPD expenses, 50% of the OPD expenses to that company or government or to that hospital, or the government is providing 50% or 100% of the surgical expenses. The hospital is incurring some surgical expenses to the patient who are below poverty line, and the government is reimbursing those expenses or paying the money in advance to the hospital. So this kind of grant is considered as a grant related to income. Now this presentation and accounting is interrelated. Okay. So there are two presentation related to asset and there are two presentation related to income. So when the company is receiving the government grant related to asset, for example, there is a machinery worth rupees 1 lakh. Okay. and the company has received a grant worth rupees 60,000. Okay, there are two probable treatment for this particular thing. So if going by the deferred income, the company can recognize an asset on a gross basis for rupees 1 lakh, and the deferred government grant, this is an asset, and the deferred government grant as a liability for rupees 60,000. Okay, and for example, the life of the machine is 5 years. Okay, so every year 1 lakh divided by 5, 20,000 depreciation in P&L. 20,000 is going to be recognized, and other income. So this grant is also going to be recognized. This 60,000 is going to be recognized over a period of 5 years. So 60,000 divided by 5, 12,000 income and 20,000 expenses. Okay. So net 8,000 expenses will be debited to P&L. Okay. So this is known as a deferred income approach. In this case, the asset has to be shown on a gross basis and the grant has to be shown on a gross basis. Okay. Asset will be depreciated over the useful life and the grant has to be amortized over the useful life of that particular asset. Okay. Deducted, the second option is deducted from the carrying value of the asset. In this case, the machinery is 1 lakh rupees, the grant is 60,000 rupees. So we will recognize the machinery at net approach 40,000 rupees. Okay. So 1 lakh rupees machinery we have received from the government 60,000 rupees. So cost to the company is 40,000 rupees. So we have deducted the value of government grant from the machinery gross value. This 40,000 is required to be depreciated over a period of 5 years. So what will be the depreciation in the P&L? 8,000. So 8,000 depreciation will be debited to P&L. So you can see in this case 20,000 minus 12,000, 8,000 will be the P&L impact, and here also 8,000 will be the P&L impact. So these are the two approaches for presentation and accounting for government grants related to assets. Sir, what about income? In case of income, there are again two approaches. For example, the government has given a hospital expenses to the hospital. So hospital can show the entire reimbursement as a other income in the P&L account separately, and the related expenses has to be shown in the expense side. Or whatever money the hospital has received from the government, that money can be deducted from the related expenses. For example, OPD expenses 15 lakh rupees. Amount received from the government 11 lakh rupees. So net 4 lakh rupees has to be shown as an expense in the P&L. Okay. So this is the accounting related to government grants, related to assets and related to income. So there are two approaches in layman language, which is gross approach and net approach. Quickly, we will do this case study. Government grant related to asset. AB Limited receives 15 million from a local council to set up in a particular area. Okay. So 15 million, 1.5 crore government grant has been received. The money is paid specifically to contribute to the 80 million cost of a new factory. Why the government is giving this grant? Because the company has already constructed a new factory which is worth rupees 8 crore, and government is providing a support of 1.5 crore. Okay. And the life of the factory is 40 years. You are required to present how this item will be dealt with in the statement of profit and loss and balance sheet at the end of year 1 on both the approaches, which is deferred income approach and net approach, gross approach and net approach. So guys, going by the gross approach, this factory has to be shown on a gross basis of 80 million, 8 crore. Okay. And what will be the depreciation? 80 million divided by 40, 2 million, 2,000 will be the depreciation on a factory. And this 1.5 million divided by 40 will give you 3,75,000. So this will be shown as an expense and this will be shown as an income. What will be the net impact? Net impact is minus 2,000 plus 375. Okay. In balance sheet, this 80 minus 2,000, 78,000 will be the net value of tangible asset. And what will be the value of the deferred income? Which is 1.5 million, which is not 1.5 million, 15 million, 1.5 crores, 15 million, okay, minus 3,75,000. So this will come out as a 14,250 plus 375. Sir, what is this? So next year, 3,75,000 is also going to be amortized as a other income. So that is why this deferred income has to be bifurcated into non-current and current. So whatever, every year 3,75,000 is going to be amortized and shown as other income. So here 375 has been shown as a current liability and remaining amount has been shown as a non-current liability. So this is a gross approach. This we are calling it as a gross approach. What is a net approach? Reduction in the carrying amount. So 80 million is the total amount minus 15 million. 65 million is the cost of the asset. 65 divided by 40 will give you 1.625 million. Okay, so 16,25,000. 16,25,000. So 80 minus 15 divided by 40. So there is only a single line item in the P&L, which is 16,25,000. And there will be no any grant in the balance sheet or P&L. Why? Because the grant has been reduced from the cost of the asset. Okay. And in the balance sheet, what is the value of the net block? 65 million minus 16,25,000. 63,375. The net P&L impact will be same. If you will reduce minus 2,000 plus 375, it will give you 16,25,000. Okay. Grant related to income. The government of Haryana reimbursed the OPD expenses of Kedanta Hospital, which is treating COVID patient, amounting to rupees 1 crore pertaining to FY 1920. Advise the treatment of such support from the government. It is a grant related to income. In this case, such amount is required to be recognized in P&L either as other income or it will be reduced from the OPD expenses. So if you want to go by the gross approach, it has to be shown as other income. If you will go by the net approach, it has to be shown as a reduction from the expenses. Grant related to income. Again, the central government has announced PF support, provident fund support to the company for a particular period in this COVID situation. Advise the treatment of such support from the government. Such amount is required to be recognized in P&L as a other income or it will be reduced from the provident fund expenses. So both the approach are applicable. Now we have reached to the last part of the accounting in case of a government grant, repayment of government grants. So first of all, for example, the government has given a government grant and the entity has to comply with the condition in the next 5 years. 3 years, the entity was reasonably assured that yes, we will be able to comply with the condition. But in the 4th year, the company has defaulted in compliance with the condition. So in that year, the grant is repayable. So first of all, because earlier the entity was reasonably assured that we will be able to comply with the condition, but now the default has been occurred. Okay, so standard says that the repayment of government grant has to be treated as a change in estimate. It has to be accounted like a change in estimate. And when it has to be accounted like a change in accounting estimate, it has to be applied prospectively. The impact has to be applied prospectively, means retrospective restatement, retrospective application is not required. Okay, whatever you have to do prospectively. You have to pass the necessary impact in the year of repayment. Okay, now we understood that this has to be recognized as a change in estimate. But what happens, how to make this accounting, how to do this accounting? If the grant is related to income, okay, and doesn't matter if the grant is related to income and the company has followed a gross approach. Gross approach means the company has followed a gross approach or the company has followed a net approach. Okay, in that case, if the grant is related to income and any unamortized deferred balance is there, any unamortized deferred government grant liability is there, first of all, that liability has to nullify, that liability has to be debited and money has to be credited. For example, there was a deferred unamortized grant or deferred government grant worth rupees 4 lakh was there and the repayment is 5 lakh rupees. So 4 lakh has to be knocked off from the liability and 1 lakh has to be debited to immediately debited to P&L. Okay, so whatever balance is there, that has to be debited in P&L. Sir, but what happens if the grant is related to an asset? In case the grant is related to an asset, okay, and the company has taken a gross approach. Gross approach means the asset has been taken at a gross value and the grant has been taken as a deferred grant. Okay, in that case, whatever balance is lying in the deferred government grant, first of all, that repayment has to be knocked off from the deferred government grant liability balance. If there is over and above repayment from the deferred government grant liability balance, the remaining amount has to be charged to P&L. Okay, but if the company has followed a net approach. Net approach means the company has reduced the government grant from the cost of the asset. In that case, in the year of repayment, whatever repayment is there, that has to be added to the cost of the asset. Okay. And so first of all, that repayment of the government grant has to be added to the cost of asset. Why? Because the asset has been deducted initially by the value of the government grant. So whatever the government grant is going to be repaid, that has to be added to the cost of the asset. And if this government grant if this government grant was not there, or if the company would have applied the gross approach, then what will be the depreciation till date? That total depreciation has to be deducted while arriving at the value at the end of the year. Okay, so we will discuss a case study on this. Below facts are given for AG Limited, and CFO needs an advice for the treatment of refund in case of both the methods. Cost of machinery A is 15 lakh. Life of machinery A is 5 years. It means 3 lakh is the depreciation per annum. And the government grant received is 5 lakh rupees. So going by the gross approach, 15 lakh has to be shown as cost of the asset, 5 lakh has to be shown as a government grant, and every year 3 lakh rupees depreciation is required to be charged, and every year 1 lakh rupees other income is required to be recognized. Okay, going by the gross approach. Going by the net approach, 15 minus 5, 10 lakh is the cost of the asset, and 10 lakh divided by 5, 2 lakh is the depreciation per annum. Okay, net impact is 2 lakh. Later on, 5 lakh is required to be repaid to the government in year 2. In the year 1, everything was good. In the year 2, 5 lakh rupees has to be repaid. So what is the accounting treatment in this particular case? Going by the gross approach, first of all, method 1. Cost of machinery A is 15 lakh, deferred income is 5 lakh. Depreciation charged in year 1 is 3 lakh, 15 by 5. Deferred income credited in P&L 5 lakh by 5, 1 lakh rupees. What is the balance of machinery at the end of year 1? 15 minus 3, 12 lakh. Deferred income liability balance 5 minus 1, 4 lakh. In the year 2, 5 lakh has to be returned back to the government, and accordingly this 4 lakh has to be debited. So accounting entry will be deferred government grant liability debit 4 lakh rupees. Okay. P&L debit 1 lakh rupees, to bank 5 lakh rupees. Okay. 4 lakh will be reduced from deferred income balance, and 1 lakh will be debited in P&L. And what is the value of the machinery at the end of year 2? Again, 3 lakh rupees depreciation, 9 lakh rupees is the value of the machinery. Please mind my word. What is the value at the end of year 2? 9 lakh rupees. So going by the net income approach, this value should be 9 lakh rupees after doing all the adjustment of repayment. Okay. So let's see. Going by the net approach, method 2. Cost of the machinery A is 15 lakh. Minus 5 lakh grant. This asset has been recognized at 10 lakh rupees. The depreciation is 10 minus 10 divided by 5, 2 lakh. So at the end of year 1, closing balance is 10 minus 2, 8 lakh. At the end of year 1, there is a closing balance of asset is 8 lakh rupees. And in the year 2, 5 lakh rupees has to be paid to the government. And hence this amount has to be added back to the cost of the machinery. Okay. So what is the balance? What is the gross balance in the machinery? 8 plus 5, 13 lakh rupees is the gross balance in the machinery. And what would have been the depreciation? If such grant would not have been there, what would be the depreciation? Of course, 15 lakh will be the cost of the asset, and per annum depreciation will be 3 lakh rupees. And what will be the depreciation for 2 years? 3 lakh multiplied by 2, 6 lakh rupees. Okay. And what is the depreciation already charged in the year 1? In this case, 2 lakh rupees. So 6 minus 2. 6 lakh rupee would have been charged by the end of 2 years. Already charged is 2 lakh. So what is the additional charge which needs to be taken into the P&L? 4 lakh rupees. Okay. So what is the carrying value of machinery A at the end of year 2 after all adjustment? So 13 lakh is the cost minus 4 lakh, which is additional depreciation, and 9 lakh is the carrying value of the machinery at the end of year 2. So it doesn't matter going by the approach 1 or approach 2. The carrying value at the end of year 2 is 9 lakh rupees. What is the forgivable loan? I have told you that the forgivable loan is a forgivable loan from government for which the government has undertaken to waive repayment under certain prescribed condition, is treated as a government grant when there is a reasonable assurance that the entity will meet the terms for the forgiveness of the loan. Why it has not been written that when the money has been received? Because the money has already been received. Okay. And hence in this case, this has to be treated as a government grant. Another one is loan at a below market rate of interest. Example, Delhi Metro Rail Corporation has received a loan from government of Japan, government of India, let's say, and the value of the interest is, let's say, the market rate of interest is 10%, and they got a loan at 8%. Okay, so standard says that the benefit of a government loan at a below market rate of interest is treated as a government grant. So in this case, first of all, the fair value of the loan on the basis of market rate of interest is required to be recognized and measured as per Ind AS 109. And the difference between the fair value of the loan on the market rate of interest versus amount actually received as a grant, the difference has amount actually received as a loan has to be shown as a government grant. So fair value of the loan as per Ind AS 109 minus amount actually received is equal to value of the government grant. So I can write that fair value of the loan on the basis of market rate of interest, on market rate of interest minus money received or proceeds received, loan received, is equal to government grant. Coming to the government assistance, I have told you the government assistance are those support which is provided by the government and the value cannot be quantified or the value cannot be placed or attached to it, and hence only the qualitative disclosure is required for these kind of government assistance. Coming to the disclosure, the important disclosures are the entity has to show the accounting policy for measurement and presentation, whether it is following a gross approach or net approach in case of a grant related to assets or grant related to income. The nature and extent of grant recognized in financial statement, indication of other form of government assistance, and if there is unfulfilled condition and other contingency attached to the amount recognized. Okay, guys, this is the complete video and complete lecture on Ind AS 20, accounting for government grants and disclosure of government assistance. As far as the standard is concerned, there is no difference between Ind AS 20 and IAS 20, which is a global standard. But as far as Ind AS 20 and accounting standard 12 is concerned, there are some differences between these two standards. For example, in AS 12, there was a concept of promoter contribution, which is not there in this particular case. Okay, so this is one of the important differences. In AS 12, the concept of government assistance was not there. The disclosure of government assistance was not there, but in Ind AS it is there. The concept of forgivable loan was not there in AS, but it is there in Ind AS. Okay, the concept of loan at below market rate of interest has to be treated as a government grant. This concept was not there in AS 12, but it is there in Ind AS. So thank you so much. Thank you for your patience listening.